Welcome to the video. First, we will set the stage by defining what it means to be upside down on a car, and why that matters when you're considering lifestyle changes like moving to one vehicle or a spouse going part-time. Next, we'll walk through real numbers, clear options, and a concrete plan to regain stability before making any big moves. To guide you, here's the agenda. First, we'll explain negative equity. Then, we'll discuss why lifestyle changes should be delayed when you have high-interest debt and no savings. After that, we'll explore practical options, a step-by-step plan, diagrams, and examples. Finally, we'll test your understanding with short quizzes and wrap up with key takeaways. Before we dive in, a quick but important disclaimer. This content is educational and not personalized financial, legal, or tax advice. Because every family situation is unique, you should consult a licensed professional who can review your full picture before you act. With that said, let's proceed carefully. Let's define negative equity precisely. When your car's market value is less than your loan payoff amount, you're upside down by that difference. Using the example, if your car is worth $10,000 and your payoff is $18,000, you are negative by $8,000. To sell the car legally and transfer the title, the full loan must be paid off. Lenders do not absorb the shortfall. You must cover the difference. If you have significant credit card debt and no savings, coming up with this cash is not feasible, which is why lifestyle changes depending on selling the car must wait. Now, to make this concrete, let's look at how the numbers can shift over 6 months. Assume the starting loan balance is $18,000 and the car's value is $10,000. Leaving negative equity of $8,000. If you reduce the loan by about $300 of principal per month, while the car's value slides by roughly $100 per month, your negative equity shrinks gradually from negative $8,000 to about negative $6,800 by month 6. These are illustrative estimates, but they show how steady principal reduction moves you toward break-even. Next, here's why the lifestyle change needs to wait. High-interest credit cards are the most immediate threat to your finances, so they must be eliminated first. You also need a safety net of 3 to 6 months of expenses to handle emergencies without new debt. If you quit a full-time job before stabilizing, you lose income, your risk increases, and your interest costs likely grow. Therefore, delaying the change and focusing on stability protects your family from deeper financial strain. Now let's compare the headline options to the real-world constraints. Selling the car now requires you to pay the $8,000 gap in cash to close the loan, which is not feasible without savings. Quitting a full-time job reduces income while debt remains, increasing danger and likely prolonging the problem. Taking a personal loan is sometimes possible, but poor credit often produces high rates that simply trade one costly debt for another unless you get a meaningfully lower APR and commit to a short term. Renting out the car can generate income if your lender and insurance allow it, but income is variable, and you must manage risk and wear. Moving on, here's your step-by-step plan. First, freeze your lifestyle by making a bare-bones budget and pausing non-essential spending. Second, list all debts with their interest rates and minimum payments, and attack the highest APRs first, using the avalanche method. Third, increase income through overtime, side gigs, or a temporary second job, and direct the extra income toward high-interest debt or the equity gap. Fourth, contact your auto lender to confirm your payoff amount, any prepayment rules, and whether your agreement allows renting the vehicle. Fifth, when cash allows, automate principal-only extra payments on the auto loan to shrink the balance faster. Sixth, track the car's value and your loan balance monthly, and reassess once you reach break-even. Seventh, build a starter emergency fund of $1,000 to $3,000, and then grow it to 3 to 6 months of expenses. Finally, only after you've stabilized should you revisit selling the car or reducing work hours. To visualize the landscape, imagine a mind map with negative equity at the center. Branches include selling now, an aggressive paydown, a personal loan bailout, renting the car, and doing nothing. Each branch has pros, cons, and risks. Selling now reduces complexity, but requires cash to cover the shortfall. Aggressive paydown steadily improves equity, but demands extra income and discipline. The personal loan can bridge the gap if the interest rate is truly lower, but it often isn't with poor credit. Renting the car can offset costs if your contract and insurance allow it, but income is uncertain and there is risk of wear and claims. Doing nothing is the riskiest, because interest accumulates and limits future options. Quiz time. If your car is worth $10,000 and your loan payoff is $18,000, What must happen to sell the car legally? Option A. The lender writes off the $8,000 difference. Option B. The buyer pays $18,000 regardless of market value. Option C. You must bring the $8,000 difference in cash or equivalent financing to close the loan. Option D. You can transfer the title and keep paying the remaining loan. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is: you must bring the $8,000 difference in cash or equivalent financing to close the loan. You cannot transfer clear title until the lender has been paid in full. Next quiz. With high-interest credit card debt and zero savings, what should you prioritize before a spouse quits a full-time job? Option A. Buy a different car with a lower payment. Option B. Pay off high APR debt and build a 3 to 6 month emergency fund. Option C. Plan a vacation first. Option D. Refinance student loans at the same rate. Please pause the video to consider your answer. We will go over the correct option in the next section. The correct answer is to pay off high APR debt and build a 3 to 6 month emergency fund. Stability must come before reducing income to avoid deepening financial risk. Now let's lock in the core principles. First, define the gap explicitly. Payoff minus value equals the shortfall you must cover. Second, prioritize in order. High-interest debt first, then build your emergency fund, then fix the car's equity, and only then consider a lifestyle change. Third, ensure extra income flows to the highest interest debt first, and then to principal on the auto loan. Fourth, only sell when you reach break-even or positive equity. Finally, if you consider a personal loan, it must deliver a lower rate, a short term, and a clearly lower total cost. Here are the top takeaways. 1. Negative equity requires covering the shortfall to sell. 2. Stability is non-negotiable, so clear high-interest debt and build a safety net before any lifestyle change. 3. Your primary levers are time, extra income, and disciplined principal reduction. 4. A personal loan is a last resort unless it clearly reduces the total cost. 5. Lifestyle upgrades should come only after your financial foundation is solid. To wrap up, define your equity gap and accept the constraint it imposes. Stabilize by eliminating high-interest debt and building a savings buffer. Use extra income and principal-only payments to close the gap. Finally, reassess at break-even and then decide whether to sell the vehicle or change work hours. Thank you for watching. If this was helpful, please like, share, and subscribe, and post your questions or your personal plan in the comments. Your experience may help someone else facing the same challenge.